Welcome back to the channel for practice problems for actuarial exams. This will be a practice problem for exam MLC, so models for life contingencies. My name is Krzysztof Ostaszewski. You can find information about me at smarturl.it/Jedi. I direct the actuarial program at Illinois State University. You can find information about it at smarturl.it/actuary. If you would like to make a tax-deductible donation to support our actuarial students, please go to smarturl.it/help-ISU-actuary. Here's a problem from the last exam MLC from spring 2017. This is written answers section, problem number 5. You have conducted a profit test for a fully discrete $100,000 5-year term life insurance policy issued to a 50-year-old. For this profit test, you are given that mortality follows the illustrative life table. There are no withdrawals. The annual gross premium is $770. The pre-contract expense is $200. Maintenance expenses payable at the beginning of the year are $20 per year, including the first year. The reserves used for the profit test are at time 0, the reserve is 0, time 1, 100, time 2, 160, time 3, 170, time 4, 120, and time 5, 0. The earned asset rate is 4%. The hurdle rate is 6%. The net present value for this policy is 144.56. Show that the net present value for the first 2 policy years, so net present value of 2, for this policy is negative 43 to the nearest 1. You should calculate the value to the nearest 0.01. Part B, calculate the discounted payback period for this policy. Now for the next part, we have new assumptions. Regulators now allow the insurer to hold 0 reserves at time 1, which would be like in full preliminary term in a regular policy. You redo the profit test, setting the reserve to be 0 for time 1, and leaving the rest of the reserves and profit test basis unchanged. For Part C, Part 1, show that the revised profit for the second year is negative 21 to the nearest 1. You should calculate the value to the nearest 1. For the second part of C, you are asked to recalculate the net present value. For Part D, your manager suggests that the negative emerging profit in year 2 should be eliminated. First part, calculate the minimum reserve at time 1 such that the emerging profit in year 2 is 0. And for the second part, explain why the negative emerging profit in year 2 is undesirable from the perspective of the insurer. So we have the following profit test table, and just below it you see the actual calculations for the entries that you see there. The pre-contract expenses are always taken as the negative profit allocated specifically to time 0 at the very beginning. So that's negative 200 for this policy. Then the profit for the first year, calculated as of the end of the first year, is, and it's always this pattern, that you have the previous year reserve with the premium after expenses accumulated at the interest rate used for calculations within the policy, not the hurdle rate, but the rate that is credited in the policy, minus the cost of death benefits, and minus the reserves for the surviving policyholders. And whatever is left after that That's the profit. So you see this calculation for the first year here. You have 0 reserve plus the premium of 720 minus expenses of 20, accumulated at 4%, minus, based on illustrative life table, the cost of mortality payments of 592, and then also P50 is calculated based on the illustrative life table. P50 times 100 is 99.408. So the profit is approximately 88.592. For the second year, the profit is, well, the reserve, initial reserve, plus the premium, minus the expenses accumulated at 4%, minus the cost of mortality payments based on the illustrative life table, that's 642, and minus the reserve, expected reserve for the surviving policyholders. And again, we get a value of P51 from the illustrative life table. We actually get Q51 from the table, and 1 minus that is P51. And this turns out to be 83.0272. The net present value at time 2 is calculated as the expected present value of these profit amounts. But remember that the profit is calculated for all people, for all policyholders who are there at the beginning of the policy year. So you don't take into account the survival till the end of the policy year, because you take survival into account by holding, at the end of the year, holding the reserves only for the surviving policyholders. And you see that calculation in the profit calculation, or consideration for those reserves. That's the last entry in the previous two calculations. So the net present value is that negative setup expense, being a negative profit at that time, plus a discounted value of profit for the first policy year, and it's only discounted, there is no probability, because you do this from the perspective of the beginning of the policy year. There is no accounting for survival here. Plus, for people who survive the first policy year, you do the same discounting for the profit for the second year, because those are the people who are there at the beginning of the second policy year. Once you plug in all the numbers, and P50, of course, you get from the illustrative life table, but we already did this. We already looked it up for the first part, for the previous calculation. We end up with a negative 42.966181, or approximately negative 42.97. So we see that the discounted payback period, which is a period of time that it takes to cover the expenses of setting up the policy, more or less. That's given as 200 here. But it's discounted, or the profits that cover that expense are discounted at the hurdle rate, and you take into account that you collect profits only from surviving policyholders. So that's why we calculated that kind of expected present value. But remember, we only take the survival to the beginning of the policy year into consideration. And we saw that, well, we didn't recoup the expenses in the first 2 years. So the discounted payback period is more than 2 years based on the above calculations. Calculations we already did. So let's calculate the net present value at time 3. We're going to have a profit in the third year of what? The initial reserve plus the premium minus expenses accumulated at 4%, minus the cost of mortality, which we get based on an illustrative life table, minus the reserves for the surviving policyholders. And this ends up being 80.5849. And net present value based on the first 3 years is the net present value based on 2 years Remember, this calculation of net present value is at time as of time 0. That's why we talk about discounted, because it's discounted to time 0, plus the expected present value of this profit for the third year, where we account for survival to the beginning of the third year. So that's why it's 2P50, which we calculated based on the illustrative life table. I just took the ratio of the number of people in the population that you can look up in the table. Or you can just also do this as P50 times P51. Either way, you should get the same answer. But of course, the profit is calculated at the end of the third policy year, so that's why you discount by 3 years at the hurdle rate of 6%, not at the rate used inside the policy. And so not the rate used for the account value calculations. And of course, account value is just a new way of saying reserve for these universal life policies. So we end up with a positive number this time, and that means that the discounted payback period is 3 years, because net present value is negative after 2 years and positive after 3 years. Now we will use star notation when we refer to the updated values for Part C. So updated reserve at time 1 is 0 instead of previous 100. And profit in year 2 is that reserve of 0 plus 770 minus 20. So premium after expenses accumulated with interest. And we found the other values before, and we end up with negative 21 as expected for that profit. The original net present value for this policy was 144.56. That's given in the problem. With this reserve being 0, the emerging profit is changed only for years 1 and 2. We'll evaluate the change in profits and its effect on the overall net present value. We have the profit for the first year, the 770 minus 20 times 1.04 minus 592, everything as before, but now the reserve is 0 at time 1, so the profit is 188. And we just calculated the profit for the second year is negative 21. So the new net present value is the previous one plus what we see is accounting for the changes. The star profit versus the previous profit that we had before. Discounted, of course, and accounting for survival to the beginning of a second policy year. And then we have all the numbers here. So we plug them in, and this turns out to be 146.426643 versus previous 144.56. We will now calculate the minimum reserve at time 1 such that the emerging profit in year 2 is 0. We set the emerging profit in year 2 equal to 0 with the reserve set as the starting reserve. So we do the standard, again, this profit calculation, which is very similar to the recursive reserve calculation. So the reserve at time 1 plus the premium minus expenses accumulated with interest minus the cost of mortality minus the expected reserve, that's 0. And from this we calculate 1V to be approximately 20.17. So that's first part of Part D. Now these negative emerging profits, if they show up, they indicate that the insurance company would have to pay money from its surplus to cover this loss effectively. And this is bad financial management. This means that either profits from other lines of business must be sacrificed, or even worse, capital may have to be raised externally because those costs have to be covered. Reserves should be established in a manner such that policies are, generally speaking, self-financing after the initial outlay of capital for acquiring the new business. So it's okay to have these setup expenses and marketing expenses and and commissions and so on, but eventually the policy must work for itself, earn its keep, so to say. Please remember that this is copyrighted material. The problem comes from a past Society of Actuaries examination, so it belongs to the Society of Actuaries. It's reproduced with permission, but the solution is mine. Good luck with your studies and good luck on the test.